Stocktake is brought to you by Intelligent Investor, Australia's leading value investing research house. Get your free trial by heading to intelligentinvestor.com.au. The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Welcome to Stocktake. My name's Gaurav Sodhi. Joining me today is analyst Graham Witcomb. Hello, Graham.
Hey, Gaurav.
Phew, for a second there, I thought you weren't there. You waited a while before you acknowledged. Jeez.
The tension.
Yeah, I'm a bit jumpier than normal because, Graham, it's just the two of us today, and I know exactly why that is. It's because we're discussing Telstra, maybe the most boring stock on the ASX.
Nobody wants Telstra these days.
Oh, it's done really well.
Although you're right.
Everyone wants a bit of Telstra.
Yeah, maybe the screams to sell have subsided and now it's just buy.
I remember when I first upgraded Telstra, it was quite a controversial decision because it'd been such a poorly performing stock for the previous decade and everyone hated it. And when it went up a little bit, I remember the headline was Telstra goes up. It was such a miraculous event that we had to put it in the headline that the share price actually went up.
It was a pretty bold upgrade, I remember, because that was mid-pandemic, right? In 2020?
Was it? Yeah.
Or are you going back further?
I think it may even be was it further maybe? Well, it was around there anyway. So we're talking a good 4 or 5 years ago, at least. We should probably have prepared this so we know exactly when we upgraded. But it was, I'm thinking 4 or 5 years is when we upgraded. But it's done very well. My expectations were that for that stock, when it went through the upgrade, was that the worst was probably priced in. It was a very dominant business. And there were easy ways to improve the business if you got some decent management in there. Because the problem with Telstra had always been a problem of capital allocation. They had spent money in the wrong places and were desperate to turn Telstra, which is inherently a slow-growing dominant business, into a fast-growing tech business. So they were chasing every fad, and every few years there were these large write-offs and these crazy acquisition strategies. And I just thought, if they can just stop that, there's probably some upside here. And that is exactly what has happened, Graham. Telstra has turned from this ambitious chaser of fads to a rather conservative cash building machine.
I love hearing that about companies because it's always the opposite. It starts off as this solid cash maker and then blows it all on some ridiculous acquisition.
Yeah, you're right. You see you're quite correct, actually. I hadn't thought about that. But you see the opposite a lot. But I think there's opportunities. It's something we've got to keep aware of. And I'm always now keeping an eye on the individuals running the company. Companies have their own culture and their own, they have their own identities, but behind the scenes, it's these individuals running them, and the individuals have their own motivations and their own incentives and their own intentions. And as I'm getting more experience in this role, I find myself leaning more into that, trying to understand those factors behind the individuals. And so when Andy Penn got to Telstra, you saw a very different personality to the previous CEOs, which were very much growth driven. You know, the things he was saying were just different. And he's been probably the circuit breaker. The previous CEO, Andy Penn, was a circuit breaker that really kicked off the improvement in Telstra, and it's been carried on by the current CEO, Vicky Brady. And I've said in the piece that I think the current management, not just the CEO, but the current upper management, the C-suite, and the top-level management is probably the best Telstra has ever had. And that's saying that's a big deal because they've had some big-name executives, and I think the current crop is the top of them.
How do you think that they did change the culture of such a kind of a slow-moving stalwart like Telstra?
Yeah, I think the most important thing was altering the goals of the business. So to the market, Telstra always promised, well, to analysts, Telstra always promised quite a lot of growth. They always wanted to be a tech company and a growth company. And I think that has something to do with when the business was listed. If you remember, Graham, it was listed back in the late 90s when there was a little something called the tech bubble going on. And Telstra at one stage was given some stupid tech multiple because it was supposed to be a tech business. And that quickly evaporated. And I think Telstra for years, for decades afterwards, was always trying to recapture that multiple and recapture the glory of being a high-growth tech business. And that led it to chasing businesses in China. It always had this desire to grow a digital health business. Then they tried to do, there's so much. And they tried to do a cloud business, an enterprise business, a data center business. There's all these fads they just kept jumping on top of.
There's a Canadian competitor, TELUS, who is doing exactly that. It's chasing now these health businesses. I feel like it's just taken the playbook of Telstra of 15 years ago and thought it could try it again over in Canada.
If there's one playbook you want to avoid, it's Telstra from 20 years ago. You don't want to copy that playbook.
Yeah,
I think I see, because I cover mining, I think I see these fad chasers in such clarity that industrial analysts probably don't see that as clearly and as often as I do, as being a resources analyst.
You're used to the cyclicality.
But the cyclicality then drives investment decisions. So when a particular commodity is running, you'll see management just change. A gold company will suddenly become a uranium business. We've seen over the last 3 years a whole host of lithium businesses suddenly turn into, we've actually found some gold here. So suddenly become gold explorers.
Yeah.
And then gold explorers suddenly become
AI explorers.
The latest, I was trying to think, what's the latest fad now? The latest fad is probably
Bitcoin miners.
Bitcoin miners. Then we know we're in trouble, right? Yeah. Look, I want to just go into a little bit of detail about some of the specifics that have changed. And there's two things that really come to mind. And the first thing is the simplicity of the business. So Telstra has 50% of the mobile market. If you take the mobile business alone, it is a genuinely impressive operation. Technically, they operate one of the most sophisticated and wide-ranging geographically mobile businesses in the world. So just to operate that successfully takes some technical knowledge, and we should give them some kudos for that. But to capture market share and these incredible margins, we keep saying this, Graham, but you cover the supermarkets, and I think we have a giggle to ourselves about the trouble the supermarkets get into for generating, 5% margins, 3% margins?
Yeah, if they're lucky.
And Telstra sits there with the highest mobile EBITDA margins in the world. I'll just repeat that. The highest mobile margins in the world are captured by Telstra. It used to be.
What is that margin?
It's actually now approaching 50%.
Incredible.
Yeah. I remember when I first started covering Telstra, my base case EBITDA margin was 35%. I thought that's probably what they can earn. And I've continuously have to upgrade that over the years.
Do you think there's a danger in that earning such high margins, does that kind of attract, scrutiny from regulators or from the government? Is this a danger that it's so profitable?
Bafflingly, the regulator and the government have been completely silent on this. Look, Graham, you're on to something important there. Usually, I would say these sort of margins would be hard to sustain. And it's notable that a lot of Telstra's profit growth has actually been coming from price rises. They've restructured the business specifically so they could pull the pricing lever more effectively. They used to have 1,800 discrete mobile plans, so it was very hard for them to raise prices across 1,800 plans. Just logistically, it was really difficult to do. So one of the first things Andy Penn did when he got in was he cut 1,800 plans down to about 20. So he forced every legacy user off their old plans and forced them onto a new modern plan. And the reason he did that was, A, it saves just on the back-end costs and logistics, but B, it puts everybody on the same mobile plan, and then he can start pushing the price lever. And that's exactly what they've been doing. They've actually increased ARPU by about 40% over the last few years, and that's where all of their profit growth has come from.
Which means that it's 40% up for the users, that the people using it are paying 40% higher, right?
Exactly. Now, you might think, well, how are they getting away with that? Isn't there a competitive market? And the key that makes Telstra different is that they are blessed with woeful competitors. Optus is a offshoot of Singtel. Optus notionally has about, I want to say, 30% of the broadband market. Aussie Broadband has about 8%. Aussie Broadband makes more money than Optus does.
Gosh.
Because Optus is just awfully run. I don't know how they manage to conjure up those losses every year, but they surely appear every year. So that is not a great competitor. TPG was a fierce competitor, and if TPG had survived independently or been the dominant party in the TPG Vodafone transaction, I fear Telstra would not be in the strong position they are today. But fortunately for them, the Vodafone people got their way. And look, I will say that Vodafone has improved, or the TPG Vodafone business has improved its mobile division. They're actually profitable. They're better than they used to be, but they're saddled with huge amounts of debt. They've just sold the single best part of their entire business, which was their enterprise fiber business. They've just sold that to clear the debt. So they may make a reasonable competitor, but they just don't have the scale or the network to do it. So it's going to be always difficult for them.
Do you think there's even more spin-offs for this industry?
Well, I think that the is it black card? No. What's happened? What's that term when there's a surprise?
A black swan?
Black swan, maybe
black
swan.
goose.
Anyway, the black sheep.
Yeah.
The surprise for the industry is, I think, Aussie Broadband, which is the best run business in that entire industry. They've come from nothing to take 8-9% of the broadband business. They're now pushing into enterprise, and I think they've taken a lot of Telstra customers, and Telstra has finally realized, hey, we actually make no money in enterprise, and they've dramatically shrunk that enterprise business. But the real prize, the big change in this industry will come when Aussie and Superloop ultimately merge, and then they take over Vodafone and Optus exits the market. That's the way I see the rational ending of this saga. Business. Australia is not large enough to have 3 mobile carriers. I think they ought to have 2. 2 mobile carriers could compete more effectively than 3 could, because 2 of them are completely subscale and can't match the dominance of Telstra. So, Graham, this is how it should unfold, right? If you're writing the saga of Australian telcos, this is exactly what should happen.
And you do tend to see these when an industry gets into a duopoly situation, something in the pricing does tend to change. It switches from when there's 3 that tend to be much more aggressive with each other. When it's 2, they kind of relax a little. They then both start pushing through price increases, not trying to outcompete each other on price as much. Or at least that's what I've seen in other industries, but it could mean margins get even higher.
Well, I would have thought that as well. And you see that kind of dynamic in other markets, but I think the uniquely poor management of Telstra's competitors, if you were Optus, you'd think you'd make some attempt at trying to make a profit occasionally, and they just have not. And if you're Vodafone has the smallest network. They actually subscale. You would think that you'd be the price leader and do what TPG did and just be very aggressive on cost and price and try and be the lowest cost provider and undercut everything that Telstra does. They do not do that. Their pricing is all pretty similar, and that's why Telstra is able to gather so much market share, because the others don't compete that ferociously on price, and the network quality of Telstra is so much better. But I think with a tweak of strategy, you could have had a different outcome, but you're just not getting it. But the way this should ultimately end, and when we should probably end this little Telstra rant as well and get on to something more interesting, but the way this should ultimately end is Aussie Broadband and Superloop are the 2 mid-cap telcos that are doing reasonably well. They should probably get together at some stage, and I think that's going to happen. And then I think they should take over one of the mobile carriers. And I would say Optus should probably leave the industry. Singtel is sitting there subsidizing Australian losses for years and years. They're not making money. And Vodafone should be under Aussie Broadband management. Can you imagine? I mean, the shake-up to the industry if you got Aussie Broadband management into Vodafone, I think it would be I wouldn't want to be a Telstra shareholder in that scenario.
That's the day the stock shudders.
Yes, that's right. That's when this all falls apart. But it's quite exciting. I think there's likely to be a big change coming in the industry, and I think it's going to come from these growing, profitable mid-tier peers, these challenger brands who are doing the job that the bigger companies probably should have done, which is taking it to Telstra.
Yeah, and you've got to sell on the stock now, right?
Yeah. Look, we've done really well on Telstra. It's gone up a lot more than I thought. I think members have made more money than we expected. And I think the valuation is now looking, I mean, I never thought I'd put Telstra on the list of crazy multiple stocks, but it's now joining that list, and we've got a long list of Aussie stocks, especially big ones that are looking silly in terms of multiples, and Telstra is now on that list. So yeah, we've put a sell on the stock, and I think it's time to take your returns and move on.
Yeah. It's always hard selling a business as it's getting better, but that's when everyone's piling on. So the investment case can fall apart too.
Yes, you're right. Especially when there are potential industry changes coming, but we'll say more on that at a later stage. Now, we should probably move on as well and do something a bit more interesting. I really enjoyed your piece on Nanosonics. This is a company I think you've covered really well over years. Why don't you give us a rundown quickly? Because this is a business that's been both market darling and it's had a downfall as well, and it's kind of been resurrected. It's an interesting story here. Why don't you run us through it, and let's get into some of the detail.
It is a genuine kind of turnaround story, because it was a stock we upgraded around 10 years ago at 78 cents, and then sold it kind of 3 or 4 years later by memory at about $4, where it is now. However, we got that completely wrong. We got the buy recommendation right, but the sell was a little too early, because it then promptly went to $8. And so we missed another double there. But in the long run, it all played out, because the stock then crashed. Everyone got afraid, and it went down to, I think, like 270 or so.
Graham, I think what you mean to say is that you weren't wrong, you were just early.
Yeah, well, it can be a few years before you realize that you were right. Painful years.
Painful years, yes, we've all been there.
Yeah, nothing's worse than someone poking you and saying, why have you left money on the table? Yeah. But it just happens in this business, especially if you're trying to be conservative. You're going to sell too early, I think, in most cases. So yeah, prepare for Telstra to double from here. But anyway, so Nanosonics, it's turned around since then. Over the past couple of years, it's added at least 50% to its share price, with a big kind of tailwind there from this new device that it's come out with, and that was just approved recently. So the kind of broad picture of what Nanosonics does, it creates this device called Trophon, which is a ultrasound sterilization device that's used in hospitals and other places that use ultrasound probes. And it's done pretty well over 10 years almost from a standing start. It's grown to 35,000 of these units out there. And each of those units, this is where it is kind of a golden situation. Each of those units ends up consuming, every single use, it takes a new cartridge. And so if you picture your printer, but you're using it multiple times a day, every time you need to change the ink cartridge, and you know that HP or the other print manufacturers, they charge an absolute arm and a leg, even if you can buy the printer itself fairly cheaply. And that's exactly what Trophon is built around. It's got a moderately cheap device price, but then these cartridges have an 80% margin. And so, as this kind of installed base has grown, the consumables earnings have grown with it, and now they're kind of almost 3/4 of the revenue of this company. And so it's done incredibly well. But this is where the market is kind of focused at the moment on this new device, which is for endoscope cleaning, which is quite a different business, as we can get to in a sec. But the issue that I have with it is that the new device is really distracting from the fact that Trophon has kind of run its course. This isn't a growth company anymore. If you look at Trophon sales, 70% of hospitals already use it in the US.
70 in the US. They have a 70% market share.
They don't have a 70% market share because different hospitals can use multiple devices.
Yes, of course. Okay.
So they've got roughly a 50% market share, but the majority of hospitals already use the device. So there isn't that kind of clear runway where they can just keep going to the hospital next door and then selling this new product to them. And that means that most of the growth is just going to come from consumable sales, which they can raise prices, and that can add a few percentage points, and they'll get some benefit from increasing actual ultrasound usage as populations grow and that sort of thing. But all up, you wouldn't expect the Trophon business to grow much more than the high single digits, which is still a very good business, but it's not a crazy business that's worth 50, 60 times earnings. The new kid on the block is this Chorus device, which was approved earlier this year. And it basically follows the same model, but it's more complex to install. So I can't see the hospitals taking it up as easily. It doesn't just sit on a desk like a Trophon unit where they can buy it and sit and forget it. You need different plumbing, fixtures, and this sort of thing. So that's one issue. The other issue is that hospitals have now come out of the pandemic and they're all being crushed by wage growth, which means that they have less money to spend on capital improvements or equipment upgrades and that sort of thing. So, I can't imagine that the new device will do as well as Trophon did. It could. Like, you got to leave that possibility open. But yeah, it doesn't seem like it's going to be worth as much as the Trophon business, I think. And
it sounds as though that success is already baked into the price, Graham. That multiple you're talking about, that's surely capturing a lot of the upside, right?
Yeah, that's kind of the issue, is that if you just look at the Trophon business, it's valuable. I think it could be worth kind of $2.50 a share on its own. The current share price is about $4. So you've got at least $2.50 there of kind of real value. But the rest of the stock's valuation is basically based on a very happy outcome for the Chorus device. And that growth story could be kind of 10 years away. It's going to take a while to ramp up. It's going to take a while for the consumables to come into it. And it's more difficult to roll out and all of these kind of issues. It also doesn't have, I think it'll be interesting, but so one of Trophon's benefits was that it uses hydrogen peroxide, which kind of breaks down into water and is very eco-friendly. But Chorus uses a bunch of different chemicals for its cleaning, which I can't imagine it's going to get the same, green premium that you would put on Trophon compared to the other competitors Trophon had. So yeah, all up, I think it's going to be interesting to watch. I'm sure it's going to keep growing, but whether it's worth today's share price is still up in the air, I think.
And that second device, that's been talked about for a long time, the second product. Is there, the market's been very anxious to price this thing, and it sounds like they've been a bit carried away with it.
Well, that's part of what the crash was all about, is that it has been in the works for a long time. However, it kept on getting delayed. This is kind of an issue with this company, and why even if you could make a great story for it, it's why I always come back to this issue where management is just incredibly promotional. They really love marketing, basically. And it's done very well. You want a company, particularly a growing small medical device company, you want to have good marketers there. However, you don't want to have them marketing to the shareholders and pulling the wool over their eyes when things go bad. So the issue with Chorus is that it was delayed many times, and basically management kept disappointing shareholders for a couple of years there. And since then, it's kind of pitching Chorus as this big growth story, but it does the most ridiculous maneuver in its investor presentations, which is that it excludes all of the costs related to Chorus from the accounts. So it shows you this Trophon business, but it excludes admin expenses, it includes research costs, all of this sort of thing from that to show this imaginary profit figure. And that's just not how the business is actually run. It might sound like two different businesses based on these two devices, but actually the newest product, there's always going to be a new product to replace the ones that are going obsolete. That's just the game of medical devices, is they always have to be investing in research and development, and you just can't exclude those costs from the reality of profits. They are genuine expenses. They are going to continue recurring. And so, yeah, the idea of management excluding those just is one more.
That's crazy.
Yeah.
I particularly, I don't know this business all that well. I've never invested in it myself, but I followed your story. And what really galls me is that management wants you to ignore all the costs of the new business, right?
Yeah.
But they want you to price all the upside of the new business.
Yeah.
You can't really have it both ways.
Yeah.
It's very frustrating. I'm also surprised, Graham, that, I mean, they have, as you say, they're in 70% of hospitals. They have 50% US market share. And the trophon units are probably not as profitable as I thought. When we first covered this, and if we had said that ultimately this business is going to get to 50% market share of the US hospital system, I would have expected a larger profitability than what they're reporting. Is that reasonable or unreasonable?
No, I think it's exactly right. I think the initial idea was that it was so much better than a lot of the competition that hospitals would be, taking it up in spades, and then trophon would be able to raise the prices and kind of take a lot of cream from the consumables. But that hasn't actually happened, although it has taken a lot of market share. There's still a lot of competition in this industry, and hospitals have different options, and they're all priced competitively. And so the company just hasn't been able to raise prices as much as we might have expected ourselves 10 years ago. And despite having a 50% market share, its profits are kind of 12 million, 13 million on 170 million of revenue, which, that's under 10%, which just isn't that impressive for this kind of device maker. I think you could have made the case, and we probably did make the case 10 years ago, that it could get at least to 15%. And I think that's still possible. But you've got to start wondering, as it gets past 50% market share, how much more is actually left to squeeze.
Yeah. And it's not alone. I mean, we're seeing Nanosonics is a great example of a business that has probably underperformed over the long run, probably not as profitable as we thought, and yet the multiple has actually increased a lot more.
Yeah.
And there's a whole host of stocks on the ASX with that exact dynamic where they're not performing badly. These aren't basket cases by any means, but I would say they're probably performing averagely or just as one would expect, or maybe even below where one would expect, and yet the multiples have just gone berserk. They've been multiples of what we thought.
Yeah. People just want
single out one. Yeah. We were talking about this in the meeting this week, Graham, but JB Hi-Fi, a classic case, probably hasn't done any better than what we thought. And margins are falling, and they probably have a little bit further to fall as the COVID gains unwind. And yet the multiples kind of doubled.
Yeah.
And I'm sure you have stocks on your list with exactly the same dynamic.
Yeah, it's very strange. It's almost that people are so desperate for a growth story that they'll clutch at anything. And the growth story. I always come back to this one, statistic that I always enjoyed, which was Microsoft. When it was priced during the .com bubble, it was whatever it was, 100 times earnings or something like that. And then it took a decade for it to reclaim that share price, or even more, maybe 15 years. But every year, earnings did grow. So those investors at the peak were exactly right, that earnings were going to do well. But they just got the timing wrong. They overpaid. And I think today there are plenty of companies on the ASX that are great businesses that are going to continue growing. But if you pay too much for them, then that great business can be a lousy investment. And I think there's going to be some lessons there for ASX companies as well.
Oh, I think so too. I think we're at the point of the cycle where people have to be reminded that there's a difference between a great business and a great investment, and that the price does matter. I think that's a lesson that's going to come around maybe sooner than we think.
Yeah. That's why we talk a lot about price to earnings ratios in our articles, is because they do matter. If you're paying, there's a big difference between paying 20 times profits and 100 times profits.
And you'd think that was crazy, but 100 times profit is kind of the going rate now for a high quality business.
There are plenty out there with that. Now they just quote it as a multiple of revenue. Don't even worry about the profits. It's 100 times revenue.
The ARR multiple is back, which is probably not a good sign. Look, if you're not a subscriber and you haven't taken out a free trial, thinking about doing it, there's some good stuff at the moment. I was going to highlight a couple of maybe two articles. We put a sell on Wesfarmers, and I had a lot of fun writing that. And I think understanding why we recommend selling a very high quality business, and the thought process behind that is useful. And there's a great. I thought your Sonic piece also, Graham, was pretty interesting. Won't go into the details. I'll leave people to sign up and read it. But I thought that was worth getting into. An interesting idea. And on that obligatory promotional note, we should end it there, Graham. This was fantastic. I like the G squared power, the power of G.
Thanks.
I think this
Thanks,
works.
Gaurav.
We'll do this again. Thanks for joining me today. And for everyone else, thank you for listening.